The most important decision that you're going to make in your 50s. Let's talk about it. My name is Jason Bowers, financial planner, and welcome to my channel. So the most important financial decision in your 50s has nothing to do with picking investments. It's not about beating the market. I know that most people, that's their goal, right? One of the questions on my questionnaire is, how do you feel about your investments and what are you looking to accomplish? And the most common answer, beat the markets and protection of principal. And I'm like, wow, if I had that available to me, the line at the front door would be a lot longer than it is. But what it is about, it's about positioning yourself for the next decade, because your 50s and even into your early 60s is the most important time when it comes to planning. Why? Because you're in your peak earning years. So if you're in your peak earning years over the next 5 to 10 and you're in that window preparing for retirement, this video is going to be for you. There's one structural decision that affects taxes, it affects income, and it affects flexibility for decades. So what is that? It's about making sure that you understand that the most important thing that you can accomplish in that decade is how you position your assets for tax purposes. So Jason, what do you mean by that? Well, the nuts and bolts of it, the basics of that is going to be that there is 3 tax buckets. There's the tax deferred bucket, which we typically are very familiar with, the 401ks, the 403bs, the TSPs, the workplace retirement plans, and those traditional IRAs. Then we have the Tax Me Now bucket, which is going to be the brokerage accounts, the non-retirement accounts, the non-tax deferred, if you will. That tends to be more of our cash reserve. Maybe we inherited some life insurance and we invested that. That's going to be in the Tax Me Now bucket. So we're getting taxed as it grows. Then there's a tax-free bucket. That's typically going to be mainly your Roth IRAs. We'll talk a little bit more in detail about those as we chat those up. But the goal is to be diversified across those different strategies. And what I find when sitting down with people as they approach their 50s, in their 50s, and even in their 60s, is I find them very heavily weighted in that tax deferred bucket, very heavily into their 401ks, a lot of the federal employees in my area, so they're TSP, but they're heavily weighted there. Most of their savings are in those accounts. They don't have a ton in non-retirement accounts, and sometimes they don't have anything inside of a Roth account. And they don't understand the issues that brings long term. They don't understand until they get punched in the face by those issues, like required minimum distributions. When they transition to retirement, every distribution they take is fully taxable, which then impacts their Social Security tax rates, which then impacts their Medicare premiums. And it's a domino that gets knocked down that knocks down a bunch of other bad dominoes that we don't want to knock down. We don't want something to drag our taxes up in retirement. We don't want something that's going to drag our Medicare premiums up in retirement. We actually want those to go in the opposite direction. When we talk about saving into those 3 buckets, it's about creating options for where you're going to pull your income from. And with those options comes flexibility, the most important aspect of a retirement plan, flexibility. I've mentioned that in many of my previous videos when it comes to planning for the future. Flexibility needs to be the theme because we don't know what retirement's going to throw at us. What we want to know is that our plan is flexible to handle it when it does show up. Let's talk a little bit more about those 3 buckets. So the tax deferred bucket, the one everybody's fairly familiar with, that 401k bucket, if you will. If you're a government employee, it's going to be your thrift savings plan. If you're a state or municipality employee, a teacher, work at most hospitals, things of that nature, it's going to be a 403b. For most everybody else, it's going to be a 401k. That is going to be tax deferred. We love that it grows tax deferred. We're not paying any taxes on that, and we get a tax deduction today. We all love that, right? But then when you transition into retirement, every single dollar you pull out of there is fully taxable at ordinary income taxes. If all of your assets are in that type of bucket, then you have no control over your taxes. And that's not going to be fun because it does force you to transition into a higher tax bracket. It forces the taxes on your Social Security to be increased, and it typically will increase your Medicare premiums. Then you factor in required minimum distributions. That's when you're being forced to take money out of those accounts, maybe at a higher rate than you want to, which then impacts the longevity of those assets, lasting as long as you will. None of those are good things. Okay, if you're confused right now, trust me, none of those are good. The second bucket is the Roth bucket. We're going to talk about that here next. It's still a retirement asset, but at the end of the day, you're paying taxes on it today for freedom in the future, for tax control in the future, for flexibility in the future. Nothing comes free in this world. We all know that. Anything you want to do with a dollar, there's going to be a trade-off, and the trade-off there is there's no tax deduction today. The good news is that for most people, you can save into that tax-deferred bucket, that 401k, if you will, and still contribute into a Roth IRA. Now, there are earnings limits, and for some people, they're not eligible for contributions, but that doesn't mean that you're ineligible for Roth conversions. So for the overwhelming majority of people, a Roth strategy can be implemented into your strategy, but it needs to be done intentionally and with strategy in mind, because it can lead to higher tax rates today, potentially. So you want to understand the difference between those rates today and what your rates are expected to be in the future. That third bucket, and this is the least utilized bucket, but it's the one that has the most flexibility, is that non-retirement account, that investment account, the brokerage account, the wrap account, the advisory account. There's many different terms for it. But as long as it's not an IRA or a Roth IRA and it's invested, then it's going to be a non-qualified or non-retirement account. Those are liquid. They're taxed at the favorable capital gains rates. And for most people, that's somewhere between 0 and 15%. We all love that tax bracket. But with that being said, that gives you a third option for your retirement income strategy. It allows you to have more control over your taxes when you make that transition, because having control over your taxes is not something we typically have when we work. When we work, we make money and they tax it. Simple as that. We don't really have any other place to generate income other than employment. But when you retire, retirement means you're not employed anymore typically. So now you're pulling from this nest egg that you've saved up for years. But if you only have one type of account to pull from, your 401k, your options are that or no money. So you really have no options. But if you need, $100,000 a year for income and you pull it all from your 401k, well, you're going to have to pull 125, 130,000 just to get the 100 that you need. So that's going to put pressure on your investments at that high of a tax rate. So having a true income strategy that's intentional will allow you to have that same $100,000 of income, but pulling it from multiple accounts, some that are taxable, some that are capital gains taxed, and some that are tax-free. And you can have the same level of income, but needing to distribute less to yourself because your tax rate is under control. Jason, how do I know if I have a plan like that? Well, ask the person that you're working with. Ask them, what is my income plan when I transition into retirement? If they tell you, oh, you should be fine, everything looks good, we'll address that when we get there. You need to get up out of that chair, say goodbye, and sprint out the door. I'm sorry, maybe that relationship was decades old and they did a great job of managing your wealth and doing well for you. But at the end of the day, if they're only looking at the puzzle pieces that they get paid on and not looking at all of the other aspects of your financial situation, you do not have a financial plan. I'm sorry if you felt like you did, but you don't. That's just the way that it is. If you want to know if you have a financial plan, you sit down with your professional, ask them that income question. What is my income plan? And they should outline for you. When you transition into retirement, these are going to be your sources of income. Joe and Jane Smith, you want to retire at 65, great. Your first sources of income are going to be distributions from these three accounts. We're going to delay your Social Security benefits until 67, hypothetically. We're also going to have your pension will turn on the same year that you retire. That is a retirement income plan, something they can speak to that's intentional, that is outlined, that has some thought put into it, and that it encompasses your assets and your savings as part of the plan, not this whole, hey, you should be okay, we'll worry about it when we get there, enjoy the rest of your day. Sorry, that's an asset manager. That's not a financial planner. If you want to understand, Jason, I'm still not sure if I have a financial plan. I'm not sure how to implement these three buckets. I'm not sure. I think I have the three buckets, but I'm not sure if I have the right amount in each bucket. I don't know if I'm saving into the right buckets. Reach out to your financial professional, or more importantly, my contact information will be linked down below. Shoot me an email, introduce yourself. Let's have a great conversation around whether or not you have a plan and whether or not that plan includes a comprehensive, intentional retirement income plan. Because you know what, if it doesn't, I'd be more than happy to put one together for you. I look forward to chatting with you. Hope you enjoyed this video and look forward to watching the next one. And we'll talk to you guys soon.